Welcome, everybody. September 16th, the Market Update Desk with Scott Riley, NMLS 157524. We got a really big week that is going to be this week. It's going to tell a lot of the tale of what's going to happen probably for the next quarter. So let's review some of the information that came out in the last day or so and talk about what's going to happen tomorrow with the start of the Fed meeting. So yesterday on CNBC, the director of the CBO, Phil Swaggle, explained the three-year forecast of economic growth, and they said the projection is for our GDP to grow by 1.4% in 2025. This is in line with the Fed's latest projection as well. So it's good that those kind of match up. They expect unemployment rate to peak at 4.5 by the end of the year, and that's up from its current 4.3%. I've seen actually some reports as high as 4.6, so it's going to be curious where we level off on unemployment. Now, this is adding pressure because of the dual mandate on the Fed to cut rates. CBO thinks inflation is going to rise to 3.1, due in part by the tariffs, but they also think there are some good aspects to them. Now, this next comment is very important because it hasn't been talked about a lot. They forecast the tariffs will reduce the deficit pretty much by a staggering number, $4 trillion over the next 10 years. So that's $400 billion a year. 3.3 trillion in reduction from the revenue created from those. But also, very importantly, it's going to save $700 billion from debt service by having less interest on the debt that we pay. The forecast that there will be 1 million fewer people from immigration this year and about 700,000 in the coming years. Now, although there is less hiring, there is less supply. So the break even between employment and employees is shrinking, so that break even is getting smaller and smaller. The CBO does not contemplate what ifs, keep in mind. They're only doing things based on what is law as it is today. Now, of course, those forecasts could change if the tariffs, for example, had to be paid back. Then you're talking about a lot of potential revenue for debt reduction that may not be there or only partially there. Now, U of M did their consumer confidence survey, showed that people are still feeling more pessimistic about the current and future state of the economy. Biggest concern was that of the labor market. The share of consumers who expect the unemployment rate to rise in the next year was reported at 65%. So as we go through this week, the big thing is going to be tomorrow, the start of the Fed meeting. And this Fed meeting, we get the SEP, Statement of Economic Projections. This is going to give us that window into what they're potentially thinking. That's why what happens this week could give us a lot of read on the next quarter. Now, today we got retail sales, and that was a positive for the market. It rose 0.6, which was much stronger than the 0.2 expected. But there's also more to this. The previous reading was also revised up by 0.1. So not only was the current report very strong, but the previous was risen also. Core retail sales, which is most important and gets plugged into GDP, rose by 0.7, which was hotter than the 0.4 that the market expected. Industrial production for the month of August was reported at up 0.1, which was stronger than the negative or reduction of 0.1. But the previous report was revised down from negative 0.1 to down negative 0.4. So the 2 months net was weaker at only 0.2. Capacity utilization, now that's what measures capacity in factories, remained flat at 77.4% after a downward revision to the previous report. A utilization under 77.5 is quite low and beneath the historical average of 80%. So how's the markets taking all this? Mortgage bonds continue to trade in a really narrow band between a level of support at 101.06 and overhead resistance of 101.31. That's a pretty big spread. Bonds are testing resistance, and if we see a dovish Fed tomorrow, it could definitely help mortgage-backed securities break through and go to the next ceiling, which is about 30 basis points higher. 10-year Treasury has been going in between a range of 4.13 and 4%, but even more so for the last week or so. It's been riding between 4.05, 4.06, and 4%. 10-year currently is at 4.03, 4.03 as I'm seeing today, and it keeps moving or trying to hit that 4% or below. Now, if we can hit 4%, it closed below 4% after the Fed meeting, and hold it, we're going to be on our way to some better rates. If you're waiting, don't wait. We have these small opportunities usually to realize savings for clients. We had this last year, and I had a bunch of people thinking it was going to get down to 5%. Boom, Fed cut rates, and we jumped up to 7%. And that ability to save $200, $300, $400, $500, $600 a month evaporated. So they had a year without saving anywhere from $300 to $500 a month. Now, trying to get back down to those, mid to high fives may or may not get there. But if you're saving money, it's net money in your pocket. We're thinking the Fed probably is going to drop 0.25%. There's about a 15% betting chance they do 0.5%. The big push is going to be what's going on with the labor market, and that's what's going to drive it. What the commentary from Chair Powell will dictate how we're going to move forward. We'll stay on top of everything. We've already started a couple of refis for people, working on a couple of pre-approvals. Give us a call. We'll help you out. 616-293-2189, the Market Update Desk, your original singular market news source for West Michigan.